Let me ask you something. Have you owned investment real estate for years, built up significant equity, but now feel like you're stuck between paying a massive tax bill or staying locked into a property you've outgrown? That's the situation many real estate investors find themselves in. They want to cash in on their success, reposition their portfolio, or reduce the headaches of active management, but capital gains taxes, depreciation, recapture, and state taxes make it feel impossible. What if there's a way to reposition that equity without triggering a taxable event? That's where the 1031 exchange comes in. But not just any 1031, because if you're looking for real diversification, income potential, and a hands-off approach, there's a specific strategy to get help: Delaware Statutory Trusts, or DSTs. Today we're going to break this down in a clear, compliance-friendly way so you can understand what a 1031 exchange actually is, how DSTs allow you to defer taxes and simplify management, and how to avoid the common mistakes that catch investors off guard. Let's dive in. If you're new here, I'm Ron Glasgow, founder of Glasgow Investment Solution. For over 20 years, I've worked with real estate investors, high net worth individuals, and professionals across the country to create custom strategies for building and preserving wealth, especially through 1031 exchanges and alternative investment solutions like DSTs. If you're considering a 1031 exchange or simply want to explore options for growing and protecting your equity, this video will give you a clear foundation. A 1031 exchange, named after Section 1031 of the Internal Revenue Code, is one of the most powerful but often misunderstood tools available to real estate investors in the United States. At its core, it allows you to defer capital gains taxes when you sell one investment property and use the proceeds to purchase another like-kind property. But let's break that down a bit more. When you sell an appreciated investment property, maybe it's a rental, a commercial building, or land, you could be hit with significant tax bill. This includes capital gains taxes, depreciation, recapture, and potential state taxes, depending on where you live. In many cases, these taxes can eat up 20% to 30% or more of your profit. That's a painful hit to take, especially when you spend years or even decades building equity in that property. A 1031 provides a way out of that tax liability. Instead of selling the property, pocketing the cash, and paying taxes, you reinvest the full proceeds into another qualifying property and defer those taxes. You keep your entire equity base working for you rather than handing it over as chunk to the IRS. Let's say you bought a property for $400,000 and is now worth $1 million. If you sell it outright, you might owe taxes on $600,000 of gain, depending on your depreciation, improvements, etc. That can mean over $150,000 in taxes owed. But if you reinvest the entire $1 million through a properly executed 1031 exchange, you pay nothing in taxes today. That money continues growing and producing income. So what counts as like-kind property? Many people assume this means you must buy the exact same type of property, for example, selling a single-family rental and buying another one just like it. That's a common misconception. In reality, the IRS defines like-kind very broadly for real estate. You can exchange residential rentals for commercial property, land for apartment buildings, a retail strip mall for a portion of a medical office DST, or even multiple smaller properties into one larger investment as long as the properties are both held for investment or business use. Personal use, like primary residences, generally do not qualify. Why does this matter for retirees and high net worth investors? When you spend years building wealth through real estate, a 1031 exchange becomes more than just a tax deferral tool. It becomes a strategic lever for managing your income, reducing your tax liability, and transitioning your investment portfolio into something that fits your life today. You're no longer forced to manage tenants, toilets, and trash just to avoid a tax hit. Instead, you can move from active management into passive income. Strategies like DSTs offer a myriad of these solutions. Diversify into institutional-grade real estate you couldn't buy on your own. Use real estate to fund retirement without shrinking your equity base. Build a smoother estate transition by deferring taxes and creating income streams for your heirs. The bottom line, a 1031 exchange isn't just about taxes. It's about unlocking flexibility, income potential, and strategic control over your real estate wealth on your terms. While the 1031 exchange is a powerful tool for deferring taxes and preserving invested capital, the traditional 1031 structure does come with some significant limitations, especially for investors nearing retirement or looking for more flexibility and ease in their real estate strategy. Let's take a look at where traditional 1031 exchanges can fall short. The tight 45-day identification window. Once you sell your property, the IRS gives you 45 days to identify your replacement property or property. This is not a flexible deadline. It's firm and it begins the day your relinquished property closes. In a hot market, this can be extremely stressful. You may feel rushed into making a poor decision just to meet the deadline, especially if inventory is low, competing buyers are driving prices up, you're looking for very specific property types or markets, or you have limited time or bandwidth to fly around evaluating property. Miss the deadline and your exchange fails, meaning a massive tax bill. Number two, the 180-day closing rule on top of the identification window. You only have 180 days total to close on the replacement property. So even if you find something you like, you're under pressure to get inspections, financing, and closing done with that narrow window. For investors who are no longer full-time operators or who are trying to retire from active management, this can feel like a full-time job just to avoid taxes. Number three, equal or greater value requirement. To fully defer your capital gain taxes in a traditional 1031 exchange, you must purchase a property or multiple properties of equal or greater value than the one you sold. That means if you sell a $2 million building, you need to reinvest all $2 million. You cannot cash out even if apartment without triggering taxes. You often end up over-leveraging or settling for a less than ideal property just to meet the requirements. This is one of the most frustrating limitations for retirees who want to access some of their equity while still deferring taxes. Number 4, management burden. Most replacement properties in traditional exchanges are direct ownership. That means you're still the landlord, even if you're older, retired, or just looking for less stress. That includes managing tenants, dealing with repairs and maintenance, handling local laws, compliance, and insurance, facing vacancy risks and lease renewals. So while the taxes are deferred, the responsibility remains. And for many investors at or near retirement, the appeal of passive income without headaches of management is growing stronger. Number 5, geographic and asset type restrictions. You may have spent years building wealth in one market or property type, but if the market shifts or your risk tolerance does, finding a good like-kind property in the same category could be tough. And remember, all properties in a traditional 1031 exchange must be directly owned by you. That limits your ability to diversify across different property types, regions, or risk profile. Traditional 1031 exchanges absolutely serve a purpose, but for many investors, especially those approaching retirement or looking to simplify, the structure could be restrictive, stressful, and operationally intensive. You deferred taxes, yes, but you haven't deferred the work. The good news, there's a modern alternative that keeps the tax benefits while removing many of the limitations, and that's what we're going to talk about next. If traditional 1031 exchanges feel limiting or overly complex, you're not alone, and that's exactly where DSTs or Delaware Statutory Trust come in. A DST is a legally recognized trust structure that allows multiple investors to own fractional interest in institutional-grade real estate without the headaches of active property management. And yes, DSTs qualify as like-kind property under IRS rules, making them fully eligible for 1031 exchanges. Let's break it down. What exactly is a DST? A Delaware Statutory Trust is a passive investment vehicle that holds income-producing real estate such as apartment complexes, industrial buildings, office parks, medical centers, self-storage facilities, retail plazas. These properties are often institutional-grade assets that individual investors wouldn't have access to on their own. As an investor, you buy a fractional interest in the trust, which owns the real estate. The trust is managed by a professional sponsor company, which handles all the operations, leasing, maintenance, tenants, compliance, etc. In short, you own real estate, but you're not the landlord. Why DSTs are a game changer? 1031 exchanges through DSTs have become increasingly popular among real estate investors, especially those nearing or in retirement. This is for a few key reasons. 1, they satisfy 1031 like-kind exchange rules. First and foremost, DSTs are 1031 eligible. The IRS recognized DST interest as like-kind, which means you can use DSTs to complete a full or partial 1031 exchange. You can defer capital gains taxes, just like with a traditional property. You avoid the pressure of finding and managing replacement property yourself. This opens up a tax-efficient path to passive ownership without giving up the benefits of deferral. No management is required. This is one of the biggest benefits for retirees. With a DST, you don't deal with tenants, toilets, or turnover. You're not responsible for property maintenance. You don't worry about market timing or negotiating leases. All management is handled by the DST sponsor, so you can focus on enjoying your retirement, not becoming a full-time property manager. Institutional quality real estate access. Because DSTs pool capital from multiple investors, they can acquire high-quality, high-value properties that individual investors typically can't afford on their own. This means you gain access to prime markets across the U.S., properties already leased to national tenants, sectors like healthcare, industrial, and multifamily, professional due diligence and underwriting. It's a way to upgrade the quality of your portfolio without taking on more risk or more work. Easier timeline management. Remember the 45-day identification rule? DSTs can make this far more manageable. Because many DSTs are prepackaged and ready to close, they can serve as a primary replacement properties in your 1031 exchange, backup options if your preferred property falls through, a flexible solution for investors short on time or options. This helps ensure you don't miss deadlines and don't get stuck with a tax bill. Number 5, diversification opportunities. Unlike buying a single property, DSTs allow you to split your exchange across multiple assets. For example, if you're selling a $1.5 million property, you could put $750,000 into a multifamily DST in Texas, $500,000 to a medical office DST in Florida, and $250,000 into an industrial DST in the Midwest. This kind of geographic and asset diversification is hard to replicate in traditional real estate, especially without scaling up management. Low minimum investment. DSTs often have minimum investments starting around $100,000, far lower than the cost of purchasing full replacement properties. This lowers the barrier to entry and allows investors to complete partial exchanges, reinvest leftover equity, and gradually shift from active to passive real estate. It also makes DSTs a great solution if you're downsizing your portfolio. Estate planning advantages. For many investors, real estate is not just about income, it's about legacy. DSTs can make estate transition simpler. DST shares can be more easily divided among heirs. There's no need to sell a property or force a distribution. Inherited DST assets receive a step up in cost basis, eliminating capital gains taxes for heirs. This allows you to create a more efficient and less stressful estate plan. DSTs aren't right for everyone. They are illiquid investments, and there are specific risk and considerations that need to be evaluated with your advisor. But for many property owners looking to exit management, maintain their 1031 tax deferral, or gain access to diversified institutional grade real estate, create a passive income stream in retirement, DSTs can be a powerful tax-efficient solution. Can you pull out equity without paying taxes? Here's a critical point: a 1031 exchange must involve reinvesting the entire sale proceeds to defer all taxes. If you pull out cash, called boot, it becomes taxable. But there are legal strategies that allow for accessing liquidity over time without triggering immediate taxes, such as refinancing prior to sale, carefully timed and structured, partial 1031 exchanges where some cash is reinvested and some taxes are paid, strategic DST selection where monthly income can supplement liquidity needs. It's not that you're pulling tax-free money out of thin air, it's that you're using the IRS code to defer taxes, maintain control of your equity, and generate income that support your financial goals. This strategy is often paired with estate planning because 1031 deferral combined with the step-up in basis and death can eliminate the deferred taxes entirely for heirs. Common mistakes to avoid. If you're considering a 1031 exchange with DSTs, here are a few pitfalls to avoid. Missing the 45-day identification deadline. This is a hard deadline and failing to identify properties disqualifies the exchange. Not understanding liquidity limits. DSTs are liquid. Once you invest it, you typically cannot exit early, so you must plan carefully. Treating all DSTs as equal. Not all DSTs are created alike. Evaluate the sponsor, asset class, geographic focus, and risk profile before investing. Working with advisors who don't specialize in this. 1031 exchanges and DSTs are nuanced. You need guidance from someone who's experienced in real estate, tax rules, and investment structure. 1031 exchanges are one of the most powerful tools in the IRS tax code for real estate investors. They require strategy, timing, and expertise. If you're sitting on appreciated real estate and wondering how to reposition your equity without taking a tax hit, DSTs may offer a solution. It's not about avoiding taxes, it's about using the tax code as written to defer taxes, unlock income, and simplify your life. If you want to explore your options with a personalized strategy, I invite you to book a time with me using the link in the description below. We'll walk through your situation and see whether a 1031 exchange with your DST aligns with your goal.